Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My guest today is Jim Grant. Jim is the founder of Grant's Interest Rate Observer, a twice-monthly journal of the financial markets. He is also the author of several books, including his most recent, Paget, The Life and Times of the Greatest Victorian, a biography of the brilliant and influential English banker, economic and political writer, and editor of The Economist, whose ideas about central banking informed the U.S. Federal Reserve's response to the global financial crisis. Jim, welcome to Hidden Forces.
Thank you, Demetri.
Welcome to Hidden Forces.
I hardly recognize myself for a moment.
How are you?
Good, thank you. I'm well.
You look fantastic.
Well, thank
I told
you.
you look fantastic, lively, vibrant.
As the listeners can see.
As they can see.
Yeah.
You have a vibrant bow tie as well today. It's more colorful.
I do. I read in the Wall Street Journal that some people find bow ties to be an affectation. Affectation,
so I tweeted out, people love you. I think you're aware of this, though I don't know to the extent that you're aware of the fan club. And I tweeted out on social media that I was going to have you on the program, and I asked suggestions for questions. And one of the questions was, ask him why the bow tie.
Yeah. Right. What was the second best question?
The second best question was, what has he invested in personally? I was going to tell him gold in New York Athletic Club bags.
Right. Yeah, well, the bow tie, my father asked the same question. I was seen on television with bow tie many years ago, and my late father said, do you think that you're Dave Garroway? Now, this is a cultural reference that will not be at the front of everyone's mind. Dave Garroway was a TV personality in the 1950s. Not 1850s, 1950s. And he looked good in it. Yeah, he did.
But did you like it? Did you feel that it gave you a certain gravitas or seriousness so you didn't have to worry about that?
I don't know.
You just like it?
I liked it.
It's buttoned up.
Yeah, I like my darn bow tie, Demetri.
Yeah,
That's
I like it too. It's true. It's such a big part of who you are. I mean,
as the FT Financial Times has this irksome feature in the magazine, which is also annoying. It's called How to Spend It. This is from this lefty publication that is editorializing against all sorts of excesses in the private economy. So How to Spend It is the name of this publication, and they have a weekly section when this thing appears, and the section is called what's it called? Anyway, it's a feature of some aesthete. It might be the aesthete of the month, for all I remember. And they always ask, what is your style signifier? And I was hoping, Demetri, that you might ask me what my style signifier is.
And I think I did, didn't I?
It's my bow tie.
Yeah, it's your bow tie. Yeah, I would have guessed that. So maybe we can, in the future, I'd love to, because I think I had actually emailed you about this months ago.
Did I ghost you?
Probably you forgot to respond. But no, the point had to do with Paget and maybe devoting an episode to him. But tell us a little bit about this book and who Walter Paget was.
Yeah. Well, Walter Paget was a most extraordinary character. He wrote wonderful prose, and he did it with the job title of financial journalist. Now, financial journalism is not the most elevated. How do I say this? If you, Demetri, find yourself at the pinnacle of financial journalism, you are still standing at sea level. That's the way it works in financial journalism. So it's a somewhat ordinary branch of the journalistic trades. But Paget, not only in his main line of work, which is writing about markets and about the political aspects of market, quite apart from that, he was a wonderful writer of biographical profiles and literary criticisms. He wrote things on William Shakespeare. He wrote things on John Milton. He wrote a great essay on, you name the political figure, and he probably wrote one about that figure, such as William E. Gladstone, the long-serving prime minister in Victorian England. So he was a most gifted writer. And what he wrote about in the financial way were things that today resonate as sharply and as controversially as they did in his day. So one of the great questions in finance is, what's money and who says so, right? Another question is, what business do people with large sums of money have in asking for favors from the government of all the people? For example, if you are at the head of a very large financial institution and you zig when you should have zagged, and there is a thunderclap in the stock market and you find yourself a little short of cash, are you then allowed to go to the Federal Reserve and say, I would like 6 or 8 truckloads of $100 bills? And they say, certainly, sir. What address may we deliver?
There's been a lot of zigging lately.
Right. And the third issue that is as controversial and as inclined to argument as it was in Paget's time was, say if a firm gets into trouble, shouldn't the stockholders be responsible for making things right? This is a little bit related to the other one about whether the firms have a right to go to the central bank. But in Paget's time, every firm was a general partnership, meaning that the partners, the owners of the firm, were responsible personally for the debts of the firm, or the pro rata share. So if there was a run on the bank and the bank became insolvent or impaired, there was a capital call to the owners and not to the stockholders, which I so admire that. I think it's a great way to do business, right? Personal responsibility. So is there collective responsibility or personal responsibility? Is money the thing that is so designated by the government, or is it something that socially evolves? These fundamental questions actually have not changed much, nor have the answers. Well, the answers have.
I can guess where you fall on that.
Yeah, but we should look back. Listeners, note that he is staring at my bow tie as he says that.
So the other question that they mentioned, maybe we'll get to it. The reason I said gold and a New York Athletic Club bag is because either you had told me this once in a story, or I had read it in one of the issues of Grants years ago where you talked about walking home and you had forgotten or you had still some gold.
Oh, yeah.
Right.
I can confess this. That Julia Child had a 3-second rule. You drop something on the floor, it's okay if you pick it up. So if enough years have elapsed since a very embarrassing and self-revealing financial mistake, it's fine, right?
Yeah,
okay.
It is.
So years ago, I started buying Krugerrands, which are these 1-ounce gold coins, come from South Africa. And one of the first purchases was in the sum, I had 25 of these things, which is $25,000 was for me then really a lot of money. Now it's still a lot of money. I mean,
right.
Who wouldn't stop on the street, Demetri, and pick up $25,000 start lying there, right?
I would.
Almost everybody on this podcast would do
Unless it was gold, maybe they would.
Yeah.
There is that funny video on YouTube. I don't know if you've seen it.
Yeah. Right. Who needs that stuff? Anyway, well, this is the point of the story. So this was, I don't know, hold on a second. I must have been in the early or mid-1990s. Nobody cared about gold. So I went to the place to buy it, and I came back with it, and it was in a Grants canvas bag. We give these things away at our conferences. Actually, we don't give them away. They come and pay a lot of money, and they get one for the part of the price. Okay, so I had it in mind to carry this gold home on the subway. And I realized at about 2 a.m, I had not done that. I left it stacked on the desk. Now, fortunately, my desk is rather like a police crime scene. It's not exactly ordered.
I thought it was a paperweight. Yeah.
So I was thinking, it'll probably be there in the morning. And I thought about that for the next 5 hours. And sure enough, it was there. And I realized that because gold, whatever year it was, it might have been 1998, which is, I think it's the nadir of the gold price, which is like 200 and something dollars an ounce. And it looked like hardware. So it was safe.
Yeah. Exactly. No pun intended. So there are so many things that I want to talk to you about. I did a lot of work ahead of this conversation trying to prepare. A lot of it was just spent, as I think I told you, or maybe I told Eric this, or Evan, I don't remember who. I talked to so many people at Grants. I love Grants, and I've told my listeners this, and I've been to your conferences, love them. Some of the best guests that I've ever had on the program I've met through
Oh,
your
terrific.
conferences.
I'm glad to hear that.
Yeah, like Christopher Cole, who came on our Capital Account years ago in 2012, had presented in the fall at Grants. It's a great conference. Your stuff is the best. And I spent a lot of time going through Fed minutes. And the first thing I kind of spent a lot of time on, because with the program, we don't focus on just markets. We do all sorts of stuff. So whenever I do an episode like this, it's an opportunity for me to delve into things. And we didn't have a chance yet to talk about what happened in the repo market in September. And so I spent a lot of time doing that, both reading through minutes, but also looking at official and unofficial explanations for what happened. Maybe you can fill in our listeners. I mean, some people will already know, obviously, but I'm sure they'd love to hear from you.
This is a very inside baseball thing that is nonetheless very something like universal interest, because it involves, again, these big questions about the Wall Street's legitimate call on the resources of the entire government, of which we all have an interest, right? So most of us certainly contribute directly to it.
And they have been deploying those resources.
Right. So first of all, repo is a short word for repurchase, and a repurchase agreement is a kind of a collateralized loan, meaning a loan that is secured by something except the borrower's pledge to pay it. If I borrow $5 from you, say, I'll give it to you next week, that's fine. But if I give you $1 million, I expect you to sign something, or at least pledge that you, Demetri, I can have like 1/10 interest in your mansion. That'll satisfy the $1 million. So these are collateralized, and they're collateralized by Treasury securities, by the bills, bonds, and notes the Treasury issues to finance the deficit. All right, so this is a relatively commonplace transaction on Wall Street. But what was not commonplace, was quite out of the ordinary in the middle of September, was that the interest rate that people demanded to lend against the presumably unquestioned solidity of these bills, notes, and bonds, the interest rate suddenly got to 10%. Now, who earns 10% on a savings account or anything except like an Argentine bond? 10% is an extraordinary, it's a usurious rate these days. It is unnatural. So how did it get there? Well, it got there for reasons that people can guess about. One of those reasons is that in the wake of the great financial crisis, the government enacted all sorts of regulations that make markets less resilient, that tell you what you can and cannot do with your money or with your depositors' money, that make things, instead of responsive, rather rigid. Or the word of art on Wall Street, they silo money. So they say you have to have this much set aside in high-quality liquid assets.
Liquidity coverage ratios, for example.
Liquidity means just what it sounds like. It means like, as water flows, so should money. So these rules, well-intended, I suppose, as they were, have backfired in their unintended consequences, as so many rules do. And so J.P. Morgan had plenty of money that it might have lent, but to do so would have perhaps provoked the resentment or the suspicion of the regulators who live on the premises and actually work side by side with the bankers. That's how closely these institutions are regulated.
So you're saying that J.P. Morgan needed to have a certain amount on liquid reserves.
Yeah, but held more or less fallow, as a farmer would keep a cornfield fallow for a year or two by planting hay on it or something instead of corn. But anyway, it's money on ice. It is not usable. It is inert.
Though it doesn't explain the why they wouldn't have been able to borrow at a lower rate elsewhere.
Correct.
And redeploy the capital.
Correct. That explanation is quite common. You hear it quite commonly, but it's not necessarily persuasive, right? Okay, so I don't know why 10%, but what I think gets us closer to the answer is why that rate has remained, if not elevated, every day. Why the market has required constant intervention by the Fed to prevent it from rising above the target rate. I forget the target rate is like 2-something%, the very low rate. So why must the Fed be in there week after week, almost day after day, not quite day after day, but certainly week after week, injecting sums which accumulate to the most extraordinary figures, like $6 trillion.
Since September
right, these are recurring.
Yeah.
They didn't create $6 trillion to do this. They used $1 billion over and over again.
Yeah. These are overnight repos and also 30-day.
Right. These are, but short-term loans secured by the aforementioned Treasury securities. So, okay, so here's the punchline. What we think is the problem is simply that at long last, this great big deficit that appears to have been of absolutely no account in practical finance is now becoming, like, as they say, a thing. And let me explain, if I may.
When you say this deficit, what are you referring to?
The federal deficit. The federal deficit. Let's take it in gross terms, meaning we're not going to get cute and take out what the Social Security Trust Fund and the like. This is not just debt held by public investors, but the whole shooting match. Wherever it is in the ledgers of the world, the gross obligations of the federal government. So, as we all know, the deficits have gotten bigger, and therefore the debt has piled higher. We know this, but we also know that it has made no visible difference in our financial lives because mortgage rates have scarcely ever been lower. Well, as much vig to get a car loan as it ever did, but that's, for our purposes, neither here nor there exactly. But mostly rates are extremely, the state of New York, which is kind of okay financially as a rhetorical courtesy, gets to borrow at like 2.5%. So rates are low. So people will say, well, deficits don't matter. In 1981, Ronald Reagan appears before the TV cameras and says to the nation, this is, by the way, when bond yields were like 15%, 1.5. Okay, so Reagan says, we have a debt of $1 trillion. It had just crossed $1 trillion. Now, it had gone from nothing in 1789, let's say it was nothing in 1789. It was not nothing, but it was sensibly little in 1789, the Constitutional Convention. So from nothing into $1 trillion from 1789 to 2001. Today, that debt is $23 trillion, and the debt has increased since August by $1 trillion. So,
what's the nature of debt accumulation? It's exponential.
Well, this would certainly look like something that is more than just, been a bad habit. Well, bad might not be the word, but anyway. So it goes from $1 trillion to $23 trillion, and the rate of acceleration is accelerating. So it doesn't matter. Maybe it matters, and maybe the proof of that consequence is that it takes the government's main force to suppress the rate at which you borrow to finance these things. That rate wants to move up. It's being held down by the Fed and its mighty interventions. So I think that this could be kind of the leading edge of the deficit becoming a phenomenon of practical financial consequence as opposed to abstract political worry.
So this has been like a central sort of point of debate, which is, are rates low or are borrowing costs low for the government because the Fed is
put them there,
right? Is putting them there actively? Because you could argue that the Fed in some ways contributed to putting them there with its accommodative monetary policy during the boom years.
Sure.
Or are rates low for the government because people perceive it as the sort of risk-off alternative in an otherwise very risky market? And you have come down on the side of it being the Fed actively keeping rates low for some time now.
Yes, I respect the other side of the argument. Some very smart people make it. What they say is that after every financial debacle on the scale of 2008-9, or even something not quite so severe, that there is a period of, what's the term in social life? Katzenjammer, I think, is the word that's sometimes used to describe the aftermath of a big party. So there is a period of remorse and of aching heads, and this takes the form in finance of very low interest rates and very quiet and tentative activity. Right? Shh, don't talk too loud. Your father had a big night. Okay, so that's typical cyclical behavior. After a crash, there is a thud and then a period of stillness and very low interest rates. That's the book, right? All right, that's the form. But it's been 10 years, right? And why I think that the central banks have been instrumental in keeping rates as low as they have been is because rates have never been lower in the 3,000 or 4,000 years of recorded interest rate history. I think that's a pretty good inferential piece of evidence that somebody's doing something new. And look no farther than Europe and to the interest rates prevailing there. They're worldwide, much in Europe, some in Japan, about, something like $11 trillion worth of bonds, simply, IOUs, are priced to deliver a yield to the lender of less than zero. Isn't this wacky? So you want to lend to the government of Germany. You pay the government of Germany for the privilege of them accepting your money. And rather than they paying you, you pay them? Yes, that's the way it works. That's a new thing. And for pedants listening, that yes, there was some of this in short-term treasury bills in this country in the late 30s, early 40s. Yes, true, but nothing on the scale that is present today. Nor was it ever prevalent in longer-dated securities, not just treasury bills. So the downward suppression of interest rates in Japan and in Europe has naturally had its effect here as well, because the world is one big marketplace, right? So should we say, it's really interesting. My publication is called Interest Rate Observer.
Exactly.
And what I observe is something historic.
And you've been observing it for a while. The last time
we just started volume 38, number 1. And can you believe it? I am like, 45? 50 tops, right?
Tops. Last time you were on the program, you were on episode 13. That was the last time you were on the show. And we talked about how there are kids that are growing up today never seen an interest rate.
God, what they have missed. But you should have seen them, people. They were something.
They were lucrative. And they were alive. They were there. You could see them. You've called them all sorts of things, I think, microscopic interest rates. But this is something that you have been talking about, of course, and so many other people have been talking about and thinking about, and just it's to a point where you've gotten sort of tired of thinking about it. And
people have gotten tired of hearing about it, that's for sure.
Yeah. And you're like, I'll tell you how I feel about all of this, because the larger point that you're getting to, and we didn't kind of mention this when we were talking about the repo market. Yes, they have the $6 trillion number is in these sort of recurring repos. That's not permanent money, but the balance sheet's been expanding.
Oh, yes. The balance.
That's a huge thing.
Now, let's back up a little bit and say what a balance sheet is and why, in the case of the Federal Reserve.
You're teaching people some things they've never heard before.
Well,
Jim.
no, I mean,
interest rates and balance sheets.
People fling these terms around as if, oh, yes, it's like when you read a sports page now, you've got to figure out what WAR is, win above replacement value. It says what it is. All right, so balance sheet just simply gives your assets and liabilities, what you owe and what you own. And the Fed owes, in a way, the value attached to the Federal Reserve notes that some of us are fortunate enough to have in our wallets.
That's the liability on the Fed's balance sheet.
Right.
It's the value of the Federal Reserve notes that it issues in return for U.S. Treasuries.
Right, and the Treasuries are the assets.
And just for listeners who aren't familiar, when we talk about the repo market or the interbank lending market, that is the market in which the Federal Reserve operates as well. So when banks are going into that market to borrow money, the Fed is also active in that market through its open market desk. But continue, because we should get into some of those details.
Right. Not too many. They can be.
What's interesting is how that market has changed since IOER, since October of 2008, when the Fed moved from a quarter to a floor system. And that, I think, is something that we should talk about. But go ahead.
IOER, yes. Well, ladies and gentlemen, apart from interest on excess reserves, as Demetri was saying, so the Fed's balance sheet is a reflection of the oomph with which it injects credit into our lives, into the banking system. And it may or may not get from the banking system to each of every one of us, but it shows you the Fed's intentions. In the past 3 months, the Fed has the measured oomph, strength of the Fed's impulse, credit impulse, is like an annual rate of 35%, which is wild. I mean, and so the stock market goes up. It doesn't go up necessarily only because the Fed is handing it out hand over fist, but that doesn't hurt.
Well, it's erased its entire balance sheet unwind from November 2018.
Yes, it has, yeah.
A full year.
So year over year, the Fed's balance sheet is growing at 1-point-something%, but over 6 months, it has been growing an annualized, 15% or something by memory. But I do remember vividly the latest 3 months annual rate, 35%.
So before the
crisis, it's accelerating.
So before the crisis, the balance sheet was just under $1 trillion, right? It was like 800
right. 890 or something.
Something like
900,
that.
Call it.
They touched somewhere between 3.8 and 3.7 trillion before they started to increase the balance sheet again now since this repo madness. What can we infer from that? Again, this brings us back to the question, because some of the other theories, the less official theories that I've read, don't explain this simply on account of, let's say, Treasury issuance or tax payments or liquidity coverage ratios. There are some alternative explanations. But what are we to infer from this?
Wait a second. You know something. What is it?
Well, one of the things that I wasn't aware of is that non-banks like hedge funds use the interbank market to speculate. And, some of the stuff that I read suggested that maybe some of these larger commercial banks were unwilling to participate because they wanted the Federal Reserve to increase the amount of reserves in the system in order to make credit more accommodative for some of these other players in the marketplace.
I don't know, maybe, but certainly if that was the intention, they've achieved they have achieved their wish, because the Fed is now in there seemingly to stay. I'm not sure how long it's going to go on, but the Fed is in there with main force. And anyway.
Well, I mean, these banks, for example, like J.P. Morgan, you brought up earlier, their executives are remunerated in bank stock. Their corporate share buybacks are a big part of what we see now on Wall Street.
Right.
They benefit from their stocks continuing to rise. So there's a lot of incentive in the market for a lot of these actors to continue to see prices continue to rise, right?
Well, I mean, I think that's saying nothing more than people love a bull market. Everyone's on Wall Street is more or less everyone except for the renegade minority that sells stocks short. Everyone does better in a bull market. I don't think it's anything new.
So you think the sort of the banal explanations that this is a regulatory issue, it's also perhaps, this brings us back to the point about IOER, that this market, even though it was always manipulated or has been manipulated since the Fed began operating its open market desk, that the price signal within the interbank market was meaningful.
Right. Well, this is a great point, Demetri. There was something in the day called the London Interbank Offered Rate, known as LIBOR. Lie meaning untruth, and bore meaning tedious. That's the derivation of LIBOR.
I never heard that one before.
But it's actually otherwise it's called London Interbank. So the London rate was the rate that the big bank lenders and borrowers negotiate among themselves to determine the clearing rate for short-term money. And it wasn't exactly discovered in the market. We say a price discovered. Discovered, I think it's a great term. It means that a price is the result of buyers and sellers testing each other and deciding what's the right price.
This is also, by the way, not LIBOR, but the market, the repo market that we're talking about here. This is part of the larger money markets that were roiled during the 2008 financial crisis.
So before the crisis, to generalize kind of heroically, rates were discovered. Since then, they have been increasingly administered. Right. So the Fed's new pet rate, supplanting LIBOR and really supplanting the federal funds rate, is called SOFR, Secured Overnight Repo Rate or something. A friend of mine calls it New Coke. And it's a dubious improvement on the predecessor. But anyway, all these acronyms and stuff's a little bit confusing, but the point to bear in mind is that the market has been taken more and more away from price discovery and more and more toward price manipulation and administration. And what's wrong with that is that they, the manipulators and administrators, don't necessarily know what the right price is. So let me back up to the historical origins of the Fed for just like 90 seconds. So the Fed came into the world 1913, 1914 to provide seasonal assistance for commerce, particularly for the movement of crops during the autumn, when typically there was a shortage of cash and rates would spike and crises would fester. That was seasonal credit assistance for commerce. That was the idea. So now it is year-round assistance for the Federal Reserve, for the federal government to finance this burgeoning, stupendous debt. And so the possible meaning of, if I'm right about, if we, because I'm not alone at Grants, are right about this, right, that is, that the weight of the debt is now beginning to tell in the financial markets. It's a very big thing.
And you're saying that what we saw in September was partly a result of that, of the budget deficit?
There's a confluence. That you mentioned tax payment day. Yeah. There was a corporate tax payment, but everyone saw that coming. I mean, every time
I am asked to recite the reasons why this happened. I duly recite it. It doesn't make any sense.
So you think this is one of the first rumblings?
I think it's one of the first rumblings of the deficit beginning to count in a way that matters on Wall Street. And if I'm right about interest rates being unnaturally suppressed rather than naturally low, the implication of that would be that rates are going to go up.
But surely it can't be that let's say JP Morgan or Goldman Sachs wasn't willing to lend to the government at 8%.
No, people were willing to lend, but they felt constrained against lending by some of these regulations. That much I think is certain. But you, many moments ago, you said, well, why wouldn't others, there's all sorts of lending outside the banking system, right?
Yeah.
There's all these direct lending operate. Why didn't somebody come in? Well, I think this is what you get with heightened regulation, as you get barriers to the free flow of goods and services and money.
Bring that back to me to the federal deficit, because I'm not following you. Because
this repo rate is the rate charged for lending against treasuries. And if there are too many treasuries, there'll be too much demand, and the interest rate will go up, right?
Mm-hmm. So that's your larger point. Your point is that this is the rates are a beach ball. They're underwater. You're not identifying exactly how far they should go, but the point is they're suppressed. And that what we saw there was that the hand being taken off the ball.
Well, the hand is still on the ball, but the tell is that the hand is putting more and more pressure to keep the ball beneath the surface. And that pressure is measured in the amount of resources the Fed devotes to holding the rate down.
Now, you mentioned there are other people that have taken the opposite side of this trade, people like Gary Schilling, for example.
Sure, Lacey Hunt, Van Hoisington. Right?
Exactly, Lacey Hunt, both have been on this program. What makes you feel that they're wrong and you are more likely correct? Or
because it's my turn. It's my turn to be right, Demetri.
It totally is. It totally is. It's been a long time on this one.
But fair is fair.
It's hard,
because I don't know. I may be wrong, but no one profitable idea is forever profitable, right?
Sure.
Things work in cycles.
But what if in the late 90s? Maybe it started in 98. I wasn't woke during this period. I mean, I was in high school, but I wasn't really
woke now.
I'm more woke to the markets is my point.
I see.
But I think it was 98 or maybe 99 when people started using this term new paradigm economy in a way to justify the valuations that they were seeing.
Oh, sure. Yeah. That's standard procedure from the dawn of markets.
But I wonder,
there's always a rationale.
I'm thinking to myself lately, are we in a new paradigm where we have to really take into account the federal government, that the new paradigm is that the Fed genuinely will not, and that if it's not willing to, that's enough, allow these markets to correct because they need asset prices to be high, irrespective of what's happening in the real economy, that they are committed to dousing this market and preventing any kind of deflation, and that therefore betting against the market or against inflation is, by thinking in terms of traditional valuation models, is no longer accurate.
It's a new era, right?
Yeah, it's a new paradigm.
New era is the phrase.
New era. Is that what people are using today?
That was what they used in 1929.
Oh, 1929.
Well, there's always a new era, right? There's every 10, 12 years, there's nothing mechanical about these things. Otherwise, people would catch on.
But you can see it in the minutes. I mean, they've changed entirely the way they
Sure. Now they want inflation. This takes some getting used to if you're a gentleman of a certain age. They want to, and of course, they believe they can control things. But let's get back just ever so briefly to this deficit question and whether federal debt matters. There's a very now kind of increasingly established, certainly almost mainstream school of thought called modern monetary theory, which holds that no such thing as sound finance. There's only functional finance. What works is what's functional is what's right. And that Bernie Sanders is a well-known advocate of this on the stump. And it holds that government should borrow as much as it wants to. The Fed should print as much as it needs to until such time as there is visible inflation, not on Wall Street, but at the checkout counter. And until that time, and just go for it. And when the reckoning does arrive, just tax people with money. That's the approach. A guy named
that's their. It's
Abba Lerner promoted this. By the way, don't laugh. Abba Lerner
was a formidable intellect. He was in his stuff. Go online and read some of his essays. Some of it's overly technical, but much of it is not. And Keynes read this stuff and said, wow, that's really good. God help us if it ever goes into practice. But what Lerner also said is that a government can do this if it owes its debt at home to domestic borrowers. We, of course, owe a great percentage of our debt to overseas creditors.
But also the idea that you would go from the current model of managing, well, we've diverged from this corridor to a floor system, but if we just take what we had in 2008, go from this model where the Fed is active in the repo market to a place where in order to put a cap on inflation, the Fed needs to tax. It's a much less responsive mechanism for...
Right. Well, is Congress going to enact a tax hike when things get out of hand?
How's that going to work? It doesn't make any sense.
I know it doesn't. I just wanted to let the listeners know that I wasn't born yesterday.
Yeah.
I'm in touch with modern monetary theory too, just like the kids.
You've written about it. You've also spoken about it. And I didn't mention this at the top, I should have. You are the host also of Grants of the Air. What is the official name of the podcast?
Everyone's got a podcast, Demetri.
Well, yours has now been running almost 3 years. And it's quite
called
successful.
Current Yield.
Current Yield.
Yeah.
But it's also, you say it's has beautiful, what era is that music from?
Oh, that's Count Basie, April in Paris.
Ah, okay.
1955.
1955.
Which happens to be the year the Dodgers won the World Series. The Brooklyn Dodgers won the World Series.
That was the last year that they won the World Series?
The only year in Brooklyn.
When did they leave Brooklyn?
1958.
So you're just...
And I'm getting over that now a little.
So just to say, though, it's great. It's a fantastic podcast. You're so much fun. It's a lot of fun. And you really take, as Ricky Gervais would say, or any Brit, you take the piss when it comes to Eric and his vacations to all sorts of dangerous retreats. I told him, I was like, hey, last time I spoke to him, I said, so Eric, I was like, where were you this time? And he goes, no. He didn't even want to talk about it. He's been so traumatized by the experience. But people will have to listen to know what that is. So we can kind of move away from the mechanics a bit. And we talked about the deficit. We talked about treasuries. You have been bearish on treasuries for a while, and you continue to be. But so far, treasuries have been, as Gary Schelling will tell you, a phenomenal investment, long term.
What I meant to say was, yes, Gary is correct.
Gary's correct.
I didn't mean to say blah.
But one of the things that we can perceive, though it's
a treasury bond is a promise to pay in a currency that is undefined and is expandable at the whim of the central bank. That's the nature of the beast. So that's seemingly not a very good thing because the body, the institution that owes the money, the Treasury, also is in charge through the Fed, and the two are related, let's not forget, in charge of creating the value that the money embodies, right? They are in charge of either making money scarcer and more valuable or more plentiful and less valuable. So that's like a conflict of interest, right? So that conflict of interest is not very important when treasuries yield 8, 9, 10% above the rate of inflation. That's a pretty good deal, right? As it was some time ago. But when treasuries yield something less than the rate of inflation, is this such a great investment? It has been a great investment. That's different from is a great investment.
Yes. So one of the major effect of all of this is, and you alluded to it earlier, if not said it explicitly, is the distortion of prices everywhere.
Right.
In the economy.
Correct.
And also risk-taking and the perception of risk.
Right.
And we've seen this in venture. We've seen this in leveraged loans. These are things that you've written about extensively over a long period of time. And we've seen it in the valuation of assets and stocks and everything else.
And venture capital, Uber wouldn't be around except for, which is...
SoftBank, the behemoth.
Yeah. WeWork, too bad. Yeah. Yes. So Walter Paget, my hero, said that, alluding to the national symbol of Great Britain, said John Bull can stand anything, but he can't stand 2%, meaning that very low rates of interest instigate speculative behavior that ends in tears. And that was true then, it's true now, but Paget meant positive 2%.
Exactly.
Yeah.
Not negative 2%.
So low rates, big trouble. That's the age-old rule. And very low rates, very big trouble. And we'll see.
So let's talk a little bit about, like I said, you've written about this. You've written about what I've called here the unicorn industrial complex. Those are not your words.
Pretty good.
Yeah, I should be.
That's very good, Demetri. In fact, I almost think I said that.
Did you?
Well, just now I did, yeah.
Oh, you might have. And you see here, I have these pictures here. There's a unicorn here. I won't bore you with that one. This is definitely not you because this guy's wearing it.
Remember the Thurber fables for our time? And the unicorn is a mythical beast.
Yes.
But it turns out it's not. Unicorn is...
they exist.
Yeah,
they exist in Silicon Valley.
Right.
So this is a woman flattering herself in the mirror. This is a thinning mirror you can see here. And one of the things that we've really seen is enormous valuations for companies that have tapped credit markets in place of profits. And in some of the most extreme cases that we've seen have been in the case of like WeWork, where they just couldn't even get the IPO off the ground. And their founder walked away with over $1 billion after not making a profit.
Oh, man's got to eat.
Now, and it's pretty remarkable if you think about it, because the money he made was money he raised, right?
Correct.
So it's a remarkable thing.
It is remarkable. And you find these examples all over the place. You find a real estate brokerage firm in New York called Compass, which is VC funded, venture capital funded.
Also backed by SoftBank.
I think so. Anyway, the people that compete with Compass just can't believe, how do they do that? How do they pay these salaries? How do they pay this proportion of commissions? Well, they do it is indirectly through the credit environment, through easy money, through free money. That's how these structures come to be. But sooner or later, they have to do something in the way of making money because the money runs out. The free money does run out.
So, I mean, that's one place where we've seen pushback. We talked about some of the pushback we might have seen in the repo market. Another place has been in the IPO market. This was a spectacular fail. I mean, Uber was the first, I think, SoftBank investment that really went sour. It had a really crappy IPO, and it's trading well below its IPO price. And even its listing price was below SoftBank's latest valuations. And in the case of WeWork, SoftBank actually bought out Adam Newman. So they're sitting on who knows how many unrealized losses from these investments. So what do you think the significance of this is? How much longer do you think this can go on? Or are we have we already reached the tipping point in this part of the market in venture and early stage?
Well, I think this part of the market has tipped. But you'll notice that, in fact, I think the President of the United States might have remarked on this today in a tweet. The stock market keeps going up.
Yeah,
I think he did.
He's been doing that for a while.
Yeah. It's not just that the most speculative wing of the venture capital industry has kind of hit the wall. The problem goes a little bit deeper in that the suppliers to that particular segment of the unicorn world is also now hurting, right? The people who furnished WeWork with artisanal draft beer, so no more beer orders from WeWork. And there's been a great big network of suppliers set up to service companies that make no money. And so those companies are hurting. And I don't think that network is quite big enough to have a macroeconomic impact, but it doesn't help things along.
What about the leveraged loan market? Maybe you could tell our listeners what leveraged loans are, because that's one place where that's much more similar to what we did have in 2008, because these are collateralized in some cases.
A leveraged loan is one of these mystifying terms. Leverage connotes debt, right? Leveraged loan would seem redundant, like a botanic garden. Every garden is botanic, right? Right. So a leveraged loan is a loan to a speculative grade company, meaning a company that is encumbered with debt, like to a lousy credit. That's a leveraged loan. So it's a corporate loan. And such companies will borrow, for example, when they're in the throes of being taken private by a private equity sponsor or promoter. So let's say a company is trading in the stock market for a valuation of $1 billion. And along comes some private equity guy and says, you know what, that company selling for $1 billion is actually a bargain because they probably have too many people and they are not as efficient as they might be under our stewardship. And we're going to buy out the public stockholders for $1.2 billion, and we're going to make it more profitable. And we're going to take out a huge chunk of change for ourselves, and we'll borrow some of that. So they take out loans, they buy out the public stockholders, and they pay themselves a dividend. And those loans are called leverage loans. And not necessarily
bad. It all depends on what the scale of lending is and how able is the company to service the debt. But as the years roll on, as the credit cycle, as we call it, kind of gets a little rank, as people take more risks, as people become a little bit less mindful of what happened the last time, as they become bolder, the terms and conditions of lending get easier. That is to say, people in need of income, and everybody seemingly is in need of income because interest rates are so low, those people aren't so demanding of the terms on which they lend. And typically these terms include such things as a limit on how much the company can borrow. Or the terms might include a definition of the collateral the company must keep to support and sustain the asset value of that's backing the loan. But as the years have worn on since the last crisis, these terms and conditions have become eviscerated, and some of them have vanished altogether. So it's been a borrower's market, and the market has grown substantially. But we're starting to see now that a lot of these loans, not a lot, I should have the figures at hand, but increasingly the news is that the weaker credits are failing and that some of these loans are not being paid on time or are on the verge of default. And loan prices, therefore, in the open market are trading lower. So the leveraged loan market is seemingly becoming an object of suspicion rather than of fun.
And there are also ETFs that are built on this type of stuff.
Yep.
So is this a cause for concern in terms of contagion? Or again, is this really not something that, because hindsight's always 20/20, or maybe that's the wrong term. I'm actually thinking of recency bias. People, the focus is kind of looking at what happened in 2008 and using that as a template.
But most people, I think, are not so mindful of what happened in 2008. And so many people on Wall Street were not around in 2008. And it's becoming rather ancient history.
And like you said, people need the yield.
They do.
It's attractive in this world.
And people perhaps are getting a little tired of hearing about the risks, because the risks, while now becoming manifest rather than hypothetical, these risks still have not wrecked careers.
So, Jim, I want to move us to the overtime, and it'll be an opportunity for you to give our listeners some, maybe advice is too strong a word, but I'd love for you to talk about some of the companies that you've covered, because in terms of individual stocks, you've really done a great job. WeWork was one example. AT&T is another. But I also want to ask you what you think the impact that the election may have, and if markets have really been pricing that in. So for regular listeners, you know the drill. If you're new to the program, or if you haven't subscribed yet to our audiophile, autodidact, or super nerd tiers, you can do that by going into the summary for this week's episode and clicking on the link that sends you to patreon.com/hidden forces, where you can listen to this week's Overtime with Jim, where we're going to keep the mics going and we're going to talk about AT&T. We're going to talk about the election. Maybe talk a little bit about gold, which has had a pretty good run recently. And also where you can get a transcript to this week's episode, as well as a copy of this week's rundown full of unicorns, flattering mirrors, some charts of U.S. short-term interest rates and the repo market. So, Jim, hang in there and we're going to keep it going.
All right.
Today's episode of Hidden Forces was recorded at Creative Media Design Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/hidden forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.